general stocks and bonds and other stuff like that. And there were inflows into gold, physical gold. And I think maybe at the beginning of this year, similar kind of dynamic took place where people just bought gold as a haven trade.
Let's talk about some trends you've been seeing. You say money has been flowing into physical gold ETFs over the past 3 months, while money has been flowing out of the largest gold miner ETF. You say there was a similar dynamic of money flows in March 2020 during the start of the COVID crisis. As broad markets began to stabilize in April 2020, money started flowing into gold mining ETF and gold stocks increased by 100%. And you show us a chart which shows ounces in gold backed ETFs, that's the white line, versus shares outstanding of the passively managed VanEck Gold Miners ETF, the blue line. The divergence in flows since December, you say, is noteworthy and extraordinary. Noteworthy and extraordinary. Why, Chris? Why?
Right. Well, it's funny how you can use the English language to make something seem extreme. But all I'm saying is that it's worth talking about, and it doesn't happen a lot, right? That's all I'm saying. But it is noteworthy and extraordinary. Yeah. Well, it's noteworthy just because it is extraordinary in that typically the flows will, if there are flows into gold-backed ETFs, there will also be flows into gold stocks, just because whatever's driving the interest in gold will typically find its way into gold mining companies too. Because gold mining companies are essentially, gold mining stocks are a derivative of physical gold, more or less. But what's happened in the last 3 months is that we've seen inflows into the gold-backed ETFs. So people have been buying gold-backed ETFs, but they've been selling the VanEck Gold Miner ETF, the GDX, because the shares outstanding of the GDX have declined. And I think that's, and similar thing happened at the start of COVID. And I think that happened at the start of COVID because the broad market got smashed. And so people just sold gold stocks with other stocks, general stocks and bonds and other stuff like that. And there were inflows into gold, physical gold. And I think maybe at the beginning of this year, similar kind of dynamic took place where people just bought gold as a haven trade, but the stock market got hit and the gold stocks actually didn't get hit, but there were outflows from the GDX because, broadly speaking, the market sold gold stocks along with other stocks. So if the gold stocks, if the gold stocks kind of catch up to physical gold in terms of flows, then we could see the gold stocks do really well.
So that said, as an investor, if you're looking at entering the gold space right now, are the miners your best bet? Should you have a mix of the miners, physical, ETF? What would be a good approach?
I think the miners are very cheap. And they are the best way to play it. The miners are more volatile than physical gold. So, you have to be willing to kind of stomach that volatility. But the miners are cheap. They're generating lots of free cash flow. There's some headwinds to the miners in terms of cost inflation, but that's why you have to pick, the miners that might be less exposed to cost inflation.
Well, I thought it was interesting that the average cost of mining hadn't changed that much. The last numbers I was looking at, it's around $1,129.
Yeah.
I thought it was going to be greater given inflation, but it hasn't hit the mining sector yet. Is that a fair statement?
Right. Yeah, I think it's interesting because the thing about gold mining is that it takes place all over the world in all different jurisdictions, all different ways. So, we've seen a lot of inflation in the United States and in the West in terms of labor inflation, but that hasn't really existed like in South America or in Africa, for example. Like the cost of labor hasn't gone up that much in those places. The other thing is that if you have an underground mine in Quebec, for example, it doesn't use a lot of oil like petro-based energy. It uses a lot of, not a lot, but uses some hydro, which is very cheap. And it's underground. They don't use big trucks. So an underground mine in Val d'Or the cost there shouldn't really go up as much as they would have in a big open pit in Nevada. So it all kind of comes out in the wash. So that's kind of why we haven't seen yet this big increase. But I think we might start to see costs go up at various operations.
Now, you mentioned Russia. Let's bring that up a second. They are a huge producer of gold. They might not be able to, given the current sanctions, be able to sell it where they wanted to sell it. So what does this do to the price if they may only be able to get China and the Middle East as buyers here?
Yeah, I mean, I think that gold will find its way into the market in some way, shape, or form. So, I mean, they might get a really big discount for what they're selling, but gold, especially gold, Russia. I mean, it has a way of making its way into markets. So, meaning that if they sell it through India, they sell it through China, it's smuggled some way, some shape, some form. But it'll probably make its way into the market. The Russian producers probably won't get what it's worth, but I think it'll make its way into the market. I'm not concerned about that being like a supply shock for the gold market, although it's obviously not a positive thing.
Well, let me ask you this before we talk ETFs. As I had another guest on saying, look, what we saw happen in nickel, right, where the LME was like, all right, shut everything. Do you see that as ever happening in gold or silver?
I mean, I think it's always possible. I mean, there's a huge short interest in gold. I mean, there was a huge short interest in nickel. Like, why did it happen in nickel as opposed to copper or zinc or some other base metal? I mean, who knows? Somebody was caught short and they had to cover their short, and so sure. I mean, it's a huge futures market, a huge paper market in gold. Wow. So I mean, anything could happen. Sure.